Picture this. It's the roaring 20s and the stock market is booming. Suddenly, the unthinkable happens. The Great Crash of 1929 strikes. We're in a time of unprecedented prosperity, an era marked by flappers, jazz, and an economy that just seems to keep climbing. But then, out of nowhere, the world is rocked by a financial earthquake. The stock market plummets, and the roaring 20s come to a screeching halt. This is the Great Crash of 1929, and it's a crash that leaves the world grappling with a decade-long economic depression. So what exactly goes wrong? Well, it's not one single element, but a cocktail of factors. At the heart of the crash is an economic phenomenon known as overspeculation. This is when investors, driven by the euphoria of the booming market, start buying stocks on credit with borrowed money. The market is inflated beyond its actual value, creating a speculative bubble. And as with any bubble, it eventually bursts. But overspeculation isn't the only culprit here. There's also a glaring economic imbalance in play. The prosperity of the 20s isn't shared equally. A small percentage of the population is enjoying the lion's share of the wealth, while the majority is barely getting by. This imbalance is a ticking time bomb, and when it detonates, it triggers a chain reaction of bank failures and business bankruptcies. The severity of the crash and its aftermath cannot be overstated. People lose their life savings overnight, unemployment skyrockets, breadlines form on the streets. The world is plunged into what becomes known as the Great Depression. So what went wrong? It's a blend of factors that we're about to delve into. The Great Crash of 1929 serves as a stark reminder of the potential pitfalls that lie in the path of unchecked economic growth and prosperity. It underscores the importance of maintaining balance and exercising caution in the financial markets. But as we move forward, it's crucial to remember that every crash offers opportunities for learning and growth. Stay tuned as we unpack this further in the next scene. Market crashes are often fueled by a combination of factors. Let's understand these. While it's difficult to pinpoint the exact causes of market crashes, there are several contributing factors that are often present. First, let's talk about overvaluation. This occurs when asset prices are significantly higher than their intrinsic value, often as a result of speculation. Investors become irrationally exuberant, driving prices up in a frenzy of buying. But when reality sets in, the bubble bursts, and prices come crashing down. Second, panic plays a significant role. Fear is a powerful driver in financial markets. When investors start to worry that their assets are losing value, they may sell off en masse, causing prices to plummet. This panic selling can turn a market correction into a full-blown crash. Another common cause is economic crisis. This could be anything from a recession or depression, a severe tightening of credit markets, or even a global pandemic. Economic crises can create a domino effect, leading to decreased consumer spending, job losses, and ultimately, a market crash. So, what are the effects of these crashes on the economy and individuals? Well, for starters, crashes often lead to significant financial loss for investors. Retirement accounts can shrink, businesses may go under, and individuals can lose their jobs. The economy as a whole can slide into a recession, with widespread unemployment and reduced economic activity. But it's not all doom and gloom. Market crashes can also lead to regulatory changes designed to prevent future crashes. For example, the crash of 1929 led to the creation of the Securities and Exchange Commission to regulate the stock market and protect investors. And let's not forget about the opportunities that can arise in the aftermath of a crash. Prices are low, which can present buying opportunities for those with cash on hand. It's a time when fortunes can be made, and the seeds of economic recovery are sown. But here's the thing. Every crash has a silver lining. On to the 2008 financial crisis. The housing market bubble bursts, triggering a global economic meltdown. Panic ensues, but amidst the chaos, opportunities arise. Now, this may seem counterintuitive at first, but let's take a closer look. You see, economies are incredibly resilient. They are like rubber bands, stretching during times of growth and snapping back after a crash. It's this elasticity, this inherent ability to recover and rebuild, that is the silver lining in every market downturn. Consider the aftermath of the Great Depression. While it was a time of intense hardship, it was also a period of innovation and growth. New industries were born, and a wave of technological advancements transformed the way we live and work. In the face of adversity, entrepreneurs adapted, innovated, and created opportunities out of obstacles. Similarly, the financial crisis of 2008 was a dark time for many. Yet it also paved the way for a wave of financial technology innovations. Companies that we now know as industry giants used the crisis as a catalyst to redefine the financial landscape. These are not isolated examples. Time and again we see that periods of economic downturn can spur innovation, create opportunities, and drive growth. It's during these challenging times that the seeds of the next economic boom are often sown. This is not to downplay the real and significant hardships that come with economic crashes. Yet it's crucial to understand that these periods of downturn are not the end, but rather part of the cyclical nature of economies. As investors, it's our job to navigate these cycles effectively. We must keep our eyes open for the opportunities that arise during and after a market crash. These could be undervalued stocks, sectors poised for growth, or innovative companies reshaping their industries. The key is to remain adaptable, to stay informed, and to maintain a long-term perspective. It's about recognizing that market crashes, while painful, can also set the stage for the next phase of growth and prosperity. Savvy investors understand that every crisis eventually gives way to recovery. It's all about spotting warning signs, managing risks, and seizing opportunities. So how can you protect your investments during turbulent times? It starts with a solid plan. Market crashes can be daunting, but they don't have to spell disaster for your investments. One of the key strategies for weathering these storms is diversification. By spreading your investments across different asset classes, you reduce the risk of your entire portfolio taking a hit when one sector crashes. Think of it as not putting all your eggs in one basket. Another effective strategy is dollar-cost averaging. This involves investing a fixed amount in a particular asset on a regular schedule, regardless of the asset's price. When prices are low, you buy more of the asset, and when prices are high, you buy less. Over time, this approach can potentially lower the average cost per share of your investment. Now let's talk about the long-term perspective. Market crashes can cause panic, leading some investors to sell their assets in a bid to cut their losses. However, history has shown that markets tend to recover over time. By maintaining a long-term perspective, you can ride out the storm rather than getting caught in the downpour. It's also important to have a risk management plan in place. This involves setting a threshold for how much loss you're willing to tolerate and sticking to it. If your investments dip below this threshold, it could be a signal to reassess your strategy. Lastly, remember to keep your emotions in check. It's easy to let fear or greed drive your decisions, but it's crucial to stay rational and stick to your plan. Regularly review and adjust your investment strategy based on changes in your financial goals, risk tolerance, and market conditions, not on temporary market fluctuations. Remember, timing the market is nearly impossible, but staying the course can lead to wealth preservation and growth. By implementing these strategies, you can navigate market crashes with confidence and turn challenges into opportunities. After all, the ability to adapt is what sets successful investors apart. By analyzing past market crashes and recoveries, we gain valuable insights. It's like taking a step back to view the grand tapestry of financial history, seeing patterns emerge, disappear, and re-emerge again. This panoramic perspective allows us to understand the ebb and flow of markets, and to glean important lessons for our own investment journeys. Firstly, market crashes are often precipitated by a blend of factors, usually involving a surge of speculation and the resulting imbalances in the economy. It's crucial to keep an eye on these symptoms, as they can signal the approach of a downturn. But remember, it's not the end of the world. Secondly, every market crash is followed by a recovery. It may take some time and the road may be rocky, but history has consistently shown that economies have the capacity to bounce back. This resilience is a testament to the adaptability of markets and the ingenuity of people. Thirdly, during times of market turmoil, opportunities arise. When others are gripped by fear, the astute investor sees potential. This is not about profiting from others' misfortunes, but rather about recognizing the cyclical nature of markets and having the courage to act when others are paralyzed. Finally, protecting your investments during turbulent times starts with a solid plan and a diversified portfolio. Timing the market is a fool's game, but adopting a long-term perspective can lead to wealth preservation and growth. Strategies such as dollar-cost averaging and portfolio rebalancing can help weather any storm. In essence, the lessons from market crashes and recoveries boil down to this: stay informed, stay disciplined, stay calm. Panic is not a strategy, and fear is not a financial advisor. When others are panicking, that's when you need to keep your head. So there you have it. The grand tapestry of financial history is rich with lessons, if we're willing to look and learn. Stay informed, stay disciplined, and above all, stay calm when others are panicking. If you enjoyed today's video, Don't forget to smash that like button, leave a comment with your thoughts, and share this video with your friends and family. And hey, why not subscribe to ProsperFin TV and hit that notification bell? That way, you'll never miss out on our latest content, packed with financial wisdom and insights.